Section 1. A simple choice, a complex world. It's a scene we all know. You are at a bustling coffee shop. The aroma of freshly ground beans fills the air. You've just ordered your morning latte, that perfect start to a busy day. The barista tells you the total. Now comes the moment of choice. A choice that seems small, but says so much about the world we live in today. Do you reach into your pocket for a few crisp bills and some coins? Or do you pull out a plastic card, or perhaps your smartphone, to make the payment with a simple tap? This single everyday action is at the heart of a massive global shift. It is a quiet revolution happening in our wallets, on our phones, and in the very fabric of our economy. This decision between physical cash and a digital transaction is more than just personal preference. It reflects a much larger story about technology security and convenience. 10 years ago, the answer might have been simple. Most people would have paid with cash without a second thought. But today, the landscape is dramatically different. Digital payment options are everywhere. They promise speed, ease, and a seamless experience. We are told they are the future. Yet cash remains a powerful and trusted tool for millions, if not billions, of people around the world. It's a method of payment that requires no special technology, no bank account, and no internet connection. So why does this comparison between cash and digital matter so much right now, in 2024, as we look towards 2025? It matters because the way we pay for things is changing faster than ever before. New technologies are emerging constantly. Fintech companies are introducing innovative apps and services that are transforming our relationship with money. This rapid evolution brings incredible opportunities. It also presents new risks and challenges that we need to understand. The choice you make at that coffee counter is a small part of a huge, ongoing debate about privacy, security, and financial inclusion for everyone in our society. The debate isn't just academic. It has real-world consequences for all of us. It affects how small businesses operate and survive. It influences how governments manage economies and fight financial crime. And it shapes our own daily habits and financial security. Are we trading our privacy for convenience? Are the new digital systems truly as safe as we are led to believe? And what happens to those who might be left behind in a world that becomes increasingly cashless? These are not future problems. They are happening right now, and understanding the stakes has never been more critical. Section 2. The Plastic Revolution. How cards work. Next, let's look at the plastic in our wallets. Credit cards. Debit cards. These cards are so common today that it is hard to imagine life without them. A debit card is a direct link to your bank account. Money is taken almost immediately from your available funds. A credit card is a short-term loan. The credit company pays the merchant. You owe the company and pay later. If you don't pay in full, you'll be charged interest. The transaction seems instantaneous, but a lot happens behind the scenes. When you swipe Insert Tap, the terminal sends transaction details through a secure network. Merchant's bank. Card network, like Visa or MasterCard. Your bank. Your bank checks funds and runs security checks. If approved, confirmation returns to the terminal. That approved message appears in the blink of an eye. Credit cards began mid-20th century, a revolutionary moment. It started with the Diners Club card in 1950 for restaurants. Banks soon issued their own cards. The plastic revolution changed how people shop and manage money. It made larger purchases possible without cash. It fueled consumer spending and economic growth. Merchants could attract more customers despite fees. Today, cards are mature and globally accepted. Magnetic stripe, chip and pin, contactless tap to pay. Innovation keeps cards relevant alongside smartphones, but the system has challenges. It relies on banks, networks, terminals. It creates massive sensitive data, a target for fraud and hackers. The convenience of plastic comes with a built-in need for constant vigilance and security. Section 3. The Digital Frontier. Understanding online payments. Now, we move to the newest and fastest growing category, online and mobile payments. This is a broad term that covers many different technologies, but they all share one key feature. They use the internet to move money digitally, without any physical card or cash changing hands at the point of sale. This includes paying for something on a website using your saved card details, using a digital wallet like Apple Pay, using a digital wallet like Google Pay, sending money to a friend through PayPal, sending money to a friend through Venmo, sending money to a friend through Zelle. These methods are built for a connected world and prioritize speed and convenience above all else. Let's look at how a digital wallet works, for example. When you add your credit or debit card to an app like Apple Pay, the app doesn't store your actual card number on your device. Instead, it creates a unique virtual account number, also known as a token. This token is what gets sent to the merchant's terminal when you tap your phone to pay. Because the real card number is never shared, it adds an extra layer of security to the transaction. This process, called tokenization, is a major security advancement that makes mobile payments very secure. It means even if a merchant's system is hacked, your actual card details are not exposed. The rise of online payments is directly tied to the explosion of the internet and e-commerce. As more people began shopping online, there was a need for a secure and easy way to pay. Companies like PayPal were pioneers in this space, creating a trusted intermediary that allowed people to pay online without sharing their financial information directly with every website. This innovation unlocked the potential of global e-commerce. More recently, the widespread adoption of smartphones has brought these capabilities into the physical world, allowing us to use the same digital convenience in brick-and-mortar stores, blurring the lines between online and offline commerce. This digital frontier is constantly expanding. New players, often called fintech companies, are introducing innovative solutions all the time. We now have buy now, pay later services that offer instant installment loans at checkout. There are also peer-to-peer payment apps that have made splitting a dinner bill as easy as sending a text message. This rapid innovation is creating more choices for consumers than ever before. However, it also creates a more complex and fragmented landscape. Each new app and service comes with its own terms, conditions, and potential security risks, making it crucial for users to stay informed. Section 4. The invisible infrastructure costs. Behind the scenes, every payment method, whether it's cash, card, or digital, has an underlying infrastructure with associated costs. These costs are often invisible to the consumer, but are very real for businesses and society as a whole. For cash, the costs include the design, printing, and minting of new coins. There is also the significant expense of securely transporting, storing, and distributing it to banks and ATMs. Banks and businesses must also spend money on counting, sorting, and protecting the cash they handle. While a single cash transaction feels free, the system that supports it is incredibly expensive to maintain and secure. For card and online payments, the costs are different but equally significant. When a merchant accepts a card payment, they must pay several fees. These are known as interchange fees, assessment fees, and processor markups. A portion of every sale, typically between 1.5% and 3.5%, goes to the bank that issued the card network like Visa, and the payment processor that facilitates the transaction. These fees can add up to a substantial expense for businesses, especially small ones with low profit margins. These costs are often passed on to all consumers, including those who pay with cash, in the form of slightly higher prices for goods and services. The infrastructure for digital payments is entirely technological. It relies on a global network of data centers, fiber optic cables, and sophisticated software to function. Building and maintaining this secure, high-speed network requires massive, continuous investment from banks and technology companies. It also consumes a significant amount of electricity. Furthermore, there is the cost of security. Companies must invest heavily in cybersecurity measures, fraud detection systems, and compliance with complex regulations to protect the system and its users from constant threats. These are essential costs to ensure the trust and integrity of the digital payment ecosystem. Ultimately, there is no such thing as a free payment. Every method has a cost, whether it's paid directly through fees or indirectly through taxes and higher prices. When we choose how to pay, we are also choosing which infrastructure to support. The convenience of a card tap is paid for by the merchant's fees. The simplicity of cash is supported by government spending on printing and distribution. Understanding these hidden costs is a crucial part of the conversation. It helps us see that the debate is not just about personal preference, but about the economic systems we choose to build and participate in. Section 1. The Daily Dance. Convenience for consumers. When we think about how we pay for things, convenience is often the first thing that comes to mind. For the average person going about their day, convenience means simplicity and ease. Digital payments, in many ways, have become the champion of convenience. Imagine you are rushing to catch a train and need to buy a ticket. A quick tap of your smartphone or a contactless card on the reader. There is no need to fumble for the right amount of cash, no waiting for change, and no worrying about whether you have enough money in your wallet. The entire process is reduced to a single, seamless gesture that takes mere seconds to complete. This level of convenience extends into many areas of our lives. Online shopping is a perfect example. You can browse and buy products from anywhere in the world at any time of day without ever leaving your home. Your payment details can be securely stored, allowing for one-click checkouts that make purchasing almost effortless. Digital wallets and payment apps have also simplified person-to-person transfers. Splitting a restaurant bill with friends or paying back a colleague for lunch. A few taps, and it's done. This removes the awkwardness of handling cash and calculating exact change, making social transactions smoother than ever before. However, what is convenient for one person might be inconvenient for another. The convenience of digital payments depends entirely on having the right tools. A compatible smartphone, a bank account, and a reliable internet connection. For millions of people, these are not givens. For the elderly, who may be less comfortable with new technology, navigating apps and digital wallets can be a source of stress and confusion. For lower-income individuals who may not have a bank account, or for those living in rural areas with poor connectivity, a digital-first world can create significant barriers. For them, cash remains the most convenient and reliable option. Furthermore, the convenience of digital can sometimes be a double-edged sword. The same frictionless experience that makes paying so easy can also lead to mindless overspending. When you don't physically see the money leaving your hand, the psychological impact of the purchase is lessened. It's easier to lose track of your expenditures when they are just a series of digital entries on a screen. Cash, on the other hand, provides a tangible and finite resource. When your wallet is empty, you stop spending. This inherent friction can be a powerful and convenient tool for budgeting and maintaining financial discipline, a form of convenience that digital systems struggle to replicate. Now let's step behind the counter and look at convenience and cost from the merchant's point of view. For a small business owner, the choice of which payments to accept is a critical decision that affects their daily operations and their bottom line. Accepting digital and card payments can significantly enhance the customer experience. It allows them to cater to the growing number of consumers who prefer not to carry cash. A customer with a card or phone is not limited by the cash in their pocket, which can lead to larger purchases and increased sales. In a competitive market, not offering digital payment options can mean losing customers to a competitor who does. However, embracing digital payments comes with its own set of complexities for a merchant. It requires setting up hardware like card terminals and ensuring a stable internet connection. It also involves choosing a payment processor, navigating different fee structures, and managing the digital records of all transactions. This can be a steep learning curve for a small business owner who is already juggling many responsibilities. There is also the risk of technical issues. A system outage, a broken card reader can bring sales to a complete halt, causing frustration for both the merchant and the customer. These are headaches that a cash-only business simply does not have to deal with. This is why cash remains so appealing to many small businesses, from the local bakery to the neighborhood handyman. Cash is simple. There are no fees to pay on each transaction, so the full value of the sale goes directly into the owner's pocket. There is no need to wait for funds to be settled into a bank account. The money is available to use immediately. This immediate access to capital is crucial for managing daily cash flow, such as paying suppliers or paying employees. Handling cash also avoids the technical dependencies and potential points of failure that come with digital systems offering a reliable and straightforward way to do business. Ultimately, most merchants find that the best approach is to offer a mix of payment options. This allows them to capture the benefits of both worlds. They can provide the convenience that card and phone-carrying customers expect, while also welcoming those who prefer or need to use cash. However, this hybrid approach means they must bear the costs and complexities of both systems. They have to pay the fees for digital transactions while also managing the security risks and labor involved in handling physical cash. For a merchant, the landscape of convenience and cost is a constant balancing act between customer expectations and their own operational reality. When we talk about the speed of a payment, it is important to distinguish between two different concepts: transaction speed, settlement speed. Transaction speed is what we experience as consumers at the checkout counter. It's the time it takes from when you present your payment method to when the transaction is approved. Modern digital payments are incredibly fast. Contactless card payments are approved in just a couple of seconds. Mobile wallet payments are approved in just a couple of seconds. That's significantly faster than counting out cash, waiting for the cashier to verify it, and then receiving change. That speed keeps lines moving, good for customers and busy merchants. A cash transaction, while potentially slower at the point of sale, has an unbeatable settlement speed. Settlement is the process where money actually moves from the buyer's possession to the seller's. With cash, the transaction and settlement happen at the same time. The moment the merchant receives the banknotes, they have the funds. The money is final, and they can use it immediately. This instant settlement helps small businesses and individuals who need immediate access to funds to operate. There is no delay and no intermediary holding the money. For card and digital payments, the story is very different. Transaction approval is instantaneous, but settlement is not. After you tap your card and walk away with your coffee, the money does not immediately appear in the coffee shop's bank account. Instead, the transaction data is batched together with all the other card payments from that day. Those batches are sent through the payment network to be processed. The process typically takes 1 to 3 business days. During that time, the money is in transit, moving between your bank, the card network, and the merchant's bank. The merchant has made the sale but does not yet have the cash in hand. That delay between the transaction and settlement can create cash flow challenges for businesses. A restaurant owner, for example, needs to pay for fresh ingredients and pay their staff daily. If a large portion of their sales comes from cards, they might have to wait several days to receive the money they have already earned. That can make it difficult to manage day-to-day expenses. Digital transaction speed is great for customers, but slower settlement is a significant financial consideration for the merchant. It highlights a hidden trade-off in the move away from the instantaneous finality of cash. Perhaps the most significant difference between cash and digital payments lies in their cost structures. As we have touched upon, a cash transaction appears to be free for both the buyer and the seller. When you pay $5 for a coffee with a $5 bill, there are no additional fees. The merchant receives the full $5. There are indirect societal costs to producing and managing cash, but at the individual transaction level, it is a fee-free exchange. This is a powerful incentive, especially for small value transactions where even a small percentage fee can bite into profit. In stark contrast, nearly every digital transaction comes with a direct cost for the merchant. These costs are bundled into the merchant discount rate. This rate is made up of several smaller fees. The largest portion is the interchange fee, which goes to the bank that issued the customer's card. Then there is the assessment fee, which is paid to the card network like Visa or MasterCard. Finally, the payment processor, the company that provides the card terminal and facilitates the transaction, adds its own markup. Interchange fee, assessment fee, processor markup. Together, these fees typically range from 1.5% to 3.5% of the transaction. For a small business, these fees can be a major operating expense. Consider a small cafe that does $200,000 in sales per year. If their average transaction fee is 2.5%, they would be paying $5,000 annually. That is $5,000 that could have been used to invest in the business, hire an employee, or simply become profit for the owner. To offset these costs, some merchants may set a minimum purchase amount for card payments or offer a small discount for customers who pay with cash. More often, however, these costs are subtly baked into the prices of all goods, meaning all customers, including cash payers, indirectly help cover the fees. This issue of fees is a central point of tension in the payments industry. Merchant groups often argue that the fees, particularly interchange fees set by the major card networks, are too high and lack transparency. This has led to legal battles and calls for government regulation in many countries. For consumers, these fees are mostly invisible, but they have a real impact on the prices we all pay. It raises a fundamental question of fairness. Should the cost of payment convenience be borne by merchants, or should it be shared more transparently with the consumers who benefit from it? The answer to this question will shape the future cost and accessibility of all payment methods. Section 1. The physical peril, risks of carrying cash. When we consider the safety of our money, the risks associated with physical cash are the oldest and most easily understood. The primary danger of carrying cash is its vulnerability to physical theft or loss. If your wallet, filled with a significant amount of money, is stolen or simply misplaced, that money is likely gone forever. There is no central authority to call, no password to reset, and no way to cancel the lost banknotes. Cash is a bearer instrument. Whoever holds it owns it. This makes it a prime target for pickpockets and for robbers. The risk increases with the amount of cash you carry, forcing people to be constantly aware of their surroundings and take precautions. This physical peril extends beyond street-level theft. For businesses that handle large volumes of cash, the risks are magnified significantly. Retail store, restaurant, gas station. This necessitates significant investment in security measures like safes, alarm systems, and sometimes even armored transport services to move cash to the bank. These are direct, tangible costs businesses must bear to mitigate risk. There is also the risk of internal theft by employees, which can be difficult to detect and prove, creating distrust if not managed properly. Beyond theft, cash has other physical vulnerabilities. It can be damaged by fire or by water, rendering it unusable. Central banks often have procedures for replacing damaged currency, but the process can be cumbersome. Cash can also be counterfeit. Modern banknotes have complex security features, but criminals keep trying to produce fake money. Both individuals and small businesses can fall victim to counterfeit scams. The burden of identifying fake currency falls on the person accepting it. Finally, there is a health and hygiene aspect to consider, highlighted during the recent global pandemic. Physical currency passes through countless hands, accumulating germs and bacteria along its journey. While the actual risk of transmitting disease through money is generally considered low, it became a significant public concern. Many businesses began encouraging contactless payments to minimize physical contact. This highlights a unique physical risk of cash that is not present in the digital realm. The very tangibility that makes cash simple and accessible also makes it a physical object that can be lost, stolen, damaged, or carry contaminants from one person to another. Section 2. The digital danger. Fraud in the modern age. While digital payments solve the problem of physical theft, they introduce a whole new set of risks that are often more complex and harder to detect. The primary danger in the digital world is fraud. This can take many forms, but it generally involves an unauthorized party gaining access to your payment information and using it to make purchases, steal money. The most common type is card-not-present fraud. This happens when a criminal obtains your credit card number expiration date security code, often by buying stolen data online, and uses it to make purchases on the internet or over the phone. You might not realize it has happened until you check your statement and see transactions you never made. Another prevalent form of digital fraud involves the physical cloning of cards. Criminals can install skimmers on legitimate payment terminals, such as at gas pumps, ATMs. Marketing. A close-up of a credit card skimmer device being pulled away from an ATM card slot, revealing the illicit electronics hidden inside. These hidden devices secretly read and store the data from your card's magnetic stripe when you swipe it. They may also use a tiny camera to record you entering your PIN. Later, they use this stolen information to create a counterfeit or cloned card and use it to drain your bank account, run up charges on your credit. The evolution to more secure chip cards has made this type of fraud more difficult, but it has not eliminated it entirely, especially in regions where magnetic stripe technology is still widely used. The rise of mobile and peer-to-peer payment apps has also created new avenues for fraudsters. Scammers might trick you into sending them money through apps like Zelle Venmo by posing as a legitimate seller for an item that doesn't exist. Because these services are designed for instant transfers between people who know each other, the transactions are often irreversible, much like handing someone cash. Once you send the money, it is gone. Other scams involve compromising your account itself, perhaps by guessing your weak password using information from other data breaches, allowing the fraudster to drain linked bank accounts, make payments without your knowledge. The sophistication of digital fraud is constantly evolving. Criminals use advanced software and social engineering tactics to exploit weaknesses in both technology and human behavior. They operate from anywhere in the world, making them difficult to track and prosecute. While banks and payment companies invest billions in fraud detection systems that use artificial intelligence to spot suspicious activity, it remains a constant, cat-and-mouse game. The convenience of being able to pay with a click or a tap comes with the ever-present, invisible risk that a criminal somewhere is trying to do the same thing with your money. This digital danger requires a new kind of vigilance from consumers. Section 3. When systems fail, the specter of data breaches. Perhaps one of the most frightening risks in the digital payment ecosystem is the large-scale data breach. This occurs when a major company, be it a large retailer, a hotel chain, a credit reporting agency, has its computer systems hacked, and the personal and financial data of millions of customers is stolen all at once. Unlike individual fraud where one person is targeted, a data breach can expose a massive number of people to risk simultaneously. Hackers can steal vast databases containing names, addresses, credit and debit card numbers. That stolen information is often sold in bulk on the dark web. A famous real-world case was the 2013 Target data breach. During the busy holiday shopping season, hackers installed malware on point-of-sale systems. The malware captured every credit and debit card swiped in U.S. stores. Over 40 million payment cards were compromised. The fallout was immense. Target faced enormous financial costs from fines, lawsuits, and upgrading security. Millions of consumers had to cancel cards and get new ones. Many later became victims of fraud as stolen data circulated worldwide. The lesson: our financial data is only as secure as the weakest link in the payment chain. You may take every personal precaution, but your information is still held by dozens of companies. A vulnerability in any one of their systems can expose you to risk. That creates a feeling of powerlessness for consumers. Security of our most sensitive information depends on corporate cybersecurity investments and competence. This is a systemic risk in digital payment infrastructure. Consequences can be long-lasting. Beyond immediate financial fraud risk, theft of personal info can lead to identity theft. Criminals can open new credit accounts in your name, take out loans, file fraudulent tax returns. Cleaning up identity theft can take months or years to restore your name and credit. This risk simply does not exist with cash. While cash can be stolen, a thief cannot steal your identity. The specter of massive data breaches remains a dark cloud over digital payments. Section 4. Phishing and scams. Beyond technical vulnerabilities like malware and data breaches, a huge category of digital risk exploits the weakest link, the human being. This is the world of phishing and social engineering scams. A deceptive email, a text message, a phone call. It often appears to be from your bank, from a delivery service, or from a well-known company. The message tries to create urgency or fear. It might say your account has been compromised, or that a package is delayed, or that you have won a prize. Then it instructs you to click a link or open an attachment to resolve the issue. That link, however, leads not to your bank's real website, but to a convincing fake. The fraudulent website uses the same logos and the same layout. It prompts you to enter your username and your password. When you do, you are not logging into your account. You are handing your credentials directly to criminals. They can then access your real account, change your password to lock you out, and steal your money or personal information. These scams work because they prey on our trust in familiar brands and our natural impulse to react quickly to a perceived problem. Another common tactic is the tech support scam. You might receive a pop-up on your computer with a loud alarm, warning that your device is infected with a virus. The message provides a phone number to call for immediate technical support. If you call, you can be connected to someone posing as Microsoft or posing as Apple. They will convince you to give them remote access to your computer. Once inside, they may install actual malware, steal your files, or trick you into paying hundreds of dollars, often by having you enter your credit card information on a fraudulent payment page. The key lesson is that technology alone cannot protect us. The most advanced security systems can be bypassed if a user is tricked into willingly giving away their keys. This makes education and awareness the most critical tools. It is essential to learn how to spot the signs of a phishing attempt. Look for spelling errors, check the sender's email address carefully, and hover over links to see the actual destination URL before clicking. Always remember, your bank or a legitimate company will never ask you for your password or full card number via email or text. In the digital world, a healthy dose of skepticism is your best defense. Section 5. The path to resolution. When you fall victim to theft or fraud, the path to getting your money back differs dramatically between cash digital payment methods. With cash, the path is often a dead end. If your cash is stolen, your primary recourse is to file a police report. Chances of law enforcement recovering your specific stolen banknotes are extremely low. There is no transaction to trace. There is no account to freeze. Unless the thief is caught red-handed with your money, it's almost certainly gone for good. This finality is a major risk of relying solely on cash. In digital payments, the story is more hopeful. Strong consumer protection laws help. Dispute resolution processes help. If you notice fraudulent charges on your credit card statement, you can dispute them. In countries like the United States, the Fair Credit Billing Act limits liability. Often liability is as little as $50. Many card issuers offer zero liability policies. You pay nothing. Contact your bank. Report the fraud. They'll typically issue a temporary credit while they investigate. The burden of proof falls on the merchant and their bank. For debit cards, protections exist, but are time-sensitive. Report unauthorized charges quickly, typically within 2 business days. Waiting longer can increase your potential loss. With debit fraud, money is taken directly from your bank account. You will likely get it back after investigation, but you may be without funds for days or weeks. That can cause serious problems paying bills. Many experts recommend using credit cards for online purchases. The dispute process is a powerful safety net, but can be frustrating and lengthy. It requires vigilance monitoring your accounts. It requires quick action when you spot a problem. It requires clear communication with your financial institution. For scams where you authorize payment yourself, getting money back is much harder. Banks may argue you approved the transaction, a civil dispute. Despite challenges, the ability to dispute and reverse charges is a core safety advantage of digital payments over cash. Section 1. The FinTech Disruption. For decades, finance was dominated by a handful of large, established players. Traditional banks, Visa, MasterCard, they set the rules and controlled the infrastructure. But over the past decade, a new force emerged to challenge the old guard. FinTech, financial plus technology. Startups using modern tech and the internet to build new financial services. More nimble, more user-friendly, more focused on specific customer needs. They've disrupted the payments landscape. A wave of innovative apps and platforms arrived. Venmo, Zelle, Cash App, UPI in India. Sending money is now as simple and instantaneous as a text. No more checks. No more slow bank transfers for small social payments. Digital-only neobanks. No branches, entirely online. Lower fees, better interest rates, sleek, intuitive mobile apps, appealing to younger, tech-savvy users. Section 2. The new affordability. Buy now, pay later. BNPL. It's an explosive growth in payments. Klarna, Afterpay, Affirm. When you check out at an online store, or even in some physical shops, you're often given the option to pay with a BNPL service. Instead of paying the full amount up front with a card, you can split the cost into smaller, interest-free installments, typically paid back over a few weeks or over a few months. It feels like a convenient, affordable way to handle a big purchase. It offers instant gratification with a structured short-term payment plan. It often feels more manageable than credit card debt, especially for younger consumers. The approval process is often instantaneous and usually requires only a soft credit check, if any. Convenience, accessibility, zero interest. That mix has fueled rapid global adoption. For merchants, adding BNPL at checkout can boost sales. It can reduce cart abandonment. Cart abandonment, when a shopper leaves without completing purchase. It can also encourage customers to buy pricier items, leading to a higher average order value. Merchants do pay a fee to the BNPL provider per transaction. That fee is often higher than a standard credit card fee. Many merchants find the sales boost justifies the extra cost. It's become a competitive necessity in many e-commerce sectors. Fashion, electronics. But rapid rise has drawn scrutiny and regulatory concern. Critics say BNPL can encourage overspending and lead people to take on debt they can't afford. BNPL loans are easy to obtain, so individuals can accumulate multiple payment plans across different providers, making it hard to track total debt. Missed payments can mean late fees, and in some cases, those missed payments are reported to credit bureaus, damaging a consumer's credit score. Regulators around the world are grappling with BNPL, how to classify and oversee these new forms of credit. The goal? Protect consumers from harm, while still allowing financial innovation. That's the story of buy now, pay later. No discussion of the changing payment landscape would be complete without addressing the complex and often controversial world of cryptocurrencies, Cryptocurrencies, Bitcoin, Ethereum are digital or virtual tokens that use cryptography for security. Unlike traditional currencies issued by governments, they are decentralized, not controlled by any single entity like a bank or a government. Transactions are recorded on a public digital ledger called a blockchain. For proponents, this decentralization is a key feature, offering the potential for a global payment system that is free from the control and fees of traditional financial intermediaries. The promise is one of peer-to-peer transactions that are censorship-resistant and globally accessible. The reality of using cryptocurrencies for everyday payments, however, has so far fallen short of this grand vision. One of the biggest hurdles is volatility. The value of most cryptocurrencies can fluctuate wildly from one day to the next. A coffee that costs the equivalent of $5 in Bitcoin today might cost $6 tomorrow, or $4 the day after. This extreme price instability makes it impractical for most consumers and merchants. Businesses cannot easily price their goods, and consumers cannot reliably budget if the value of their money is constantly changing. This volatility has led many to view cryptocurrencies more as a speculative investment, like a stock, rather than a stable medium of exchange. Another major challenge is usability and transaction speed. Making a cryptocurrency transaction can be a complex process for the average person, requiring a digital wallet and an understanding of public keys and private keys. While the technology is improving, it is still far from the seamless tap-to-pay experience of a modern card or mobile wallet. Furthermore, some of the most popular blockchain networks, like Bitcoin, can be slow and expensive to use for small transactions. The network can become congested, leading to long confirmation times and high transaction fees, making it unsuitable for buying a simple cup of coffee where speed and low cost are essential for a good user experience. Despite these challenges, innovation continues in the crypto space. So-called stablecoins are a type of cryptocurrency designed to address the volatility problem by pegging their value to a stable asset, like the US dollar. This could make them more viable for payments in the future. Additionally, some companies are exploring the use of blockchain technology to make cross-border payments faster and cheaper than the current system. While cryptocurrencies are unlikely to replace cash or cards for your daily shopping anytime soon, they represent a fascinating and disruptive frontier. They are forcing a fundamental rethinking of what money is and how it can be moved, and they will undoubtedly continue to influence the long-term evolution of the payment landscape. The rapid influx of new players and technologies has created a complex and challenging environment for financial regulators around the world. These government and quasi-governmental bodies are tasked with a difficult balancing act. On one hand, they want to encourage innovation that can lead to better, cheaper, more inclusive financial services for the public. On the other hand, they have a critical responsibility to protect consumers from fraud, ensure the stability of the financial system, and prevent illegal activities like money laundering and terrorist financing. The speed at which fintech is evolving often outpaces the ability of regulators to create new rules, leaving them playing a constant game of catch-up. One of the central regulatory challenges is defining what these new services are. Is a buy now, pay later plan a traditional loan that should be subject to consumer credit laws? Is a digital wallet from a tech company a type of bank account that should be held to the same standards as a traditional bank? Are certain cryptocurrencies securities that should be regulated by market authorities? The answers to these questions have enormous implications for the companies offering these services and for the consumers using them. This legal ambiguity can create uncertainty and risk in the market as companies operate in a gray area while waiting for clear rules to be established. Data privacy is another major area of regulatory focus in this new landscape. Fintech apps and digital payment platforms collect vast amounts of personal and transactional data. This data is incredibly valuable, as it can be used to understand consumer behavior, offer personalized products, and target advertising. This raises critical questions about who owns this data, how it can be used, and how it must be protected. Regulations like the GDPR in Europe and similar laws in other regions are setting new standards for data privacy, requiring companies to be more transparent with consumers and giving individuals more control over their personal information. These rules are shaping how all payment providers, new and old, handle our sensitive data. Looking ahead, the future of your wallet will be shaped by the ongoing interaction between these new players and the regulatory frameworks that govern them. We can expect to see more hybrid models, where fintech companies partner with traditional banks to offer new services that combine innovation with the trust and regulatory compliance of an established institution. Regulators will likely continue to increase their oversight of the fintech space, particularly in areas like buy now, pay later, and crypto, to address emerging consumer risks. For you, the consumer, this means the choices for how you pay will continue to expand, but it will also be more important than ever to understand the terms, risks, and protections associated with each new option you add to your digital wallet. Throughout this exploration, we have journeyed through the complex, rapidly changing world of payments. We have seen that the simple act of buying a coffee is now at the intersection of centuries of tradition and the cutting edge of technology. We have weighed the tangible, universal simplicity of cash against the seamless, data-driven convenience of digital transactions. We have uncovered the hidden costs and infrastructures that support every tap, swipe, and exchange of a banknote. The central truth that emerges is simple. There is no single best way to pay. Each method carries its own profile of benefits and risks, of convenience and cost, of inclusion and exclusion. Cash offers unparalleled anonymity and finality. Digital systems provide a powerful safety net through dispute resolution. As we look toward 2025 and beyond, the narrative is not replacement, but coexistence and integration. The predictions of a completely cashless society have proven to be premature. Cash remains a vital tool for budgeting, a lifeline for the unbanked, and a reliable fallback when digital systems fail. At the same time, the relentless march of innovation continues. Fintech challengers will keep pushing the boundaries, forcing traditional institutions to evolve, and offering consumers an ever-expanding menu of choices. The future wallet will not be exclusively cash or exclusively digital. It will be a hybrid. It will be a carefully curated collection of tools, a few bills for small purchases, a credit card for secure online shopping, and a mobile wallet for quick, on-the-go payments. This hybrid reality means the debate will shift. It will move away from cash versus digital and toward a more nuanced conversation about finding the right balance. How do we ensure that as technology advances, we do not leave vulnerable populations behind? How do we harness the power of data to create better financial services while rigorously protecting our privacy? The answers will be found in thoughtful regulation, responsible innovation, and most importantly, in the informed choices we make every day. The future is not a predetermined path toward a single payment method, but a landscape of options that we must learn to navigate with wisdom and awareness. The wallet of tomorrow will be more diverse, not less. The story of money has always been a story of evolution. Bartering with goods, minting coins, printing paper money, creating digital tokens. The current transition is simply the latest chapter in this long story. The key is to understand that with each new tool comes new responsibilities. The convenience of a tap-to-pay world requires a new level of digital literacy. The rise of new forms of credit, like buy now, pay later, demands a renewed commitment to financial discipline. The wallet of tomorrow will be powerful, but its safe and effective use will depend entirely on the knowledge and vigilance of the person who carries it. Understanding the landscape is the first step. Taking action to protect yourself is the next. In this evolving world of payments, your financial security is paramount. The first and most critical action point is to become a vigilant monitor of your own accounts. Monitor accounts. Do not wait for your monthly statement to arrive in the mail. Use your bank's mobile app. Use your bank's website. Review your credit card transactions regularly, perhaps even daily. Review your bank account transactions regularly, perhaps even daily. The sooner you spot an unauthorized charge, the faster you can report it and the more protected you will be. Set up transaction alerts on your phone. so you are notified immediately every time a payment is made. This simple habit is your single best defense against fraud. Second, practice strong digital hygiene. Use strong, unique passwords for every financial account. A password manager can help you create and store these complex passwords securely. Wherever possible, enable two-factor authentication. Example, a code sent to your phone. Use 2FA. Be deeply skeptical of unsolicited emails. Be deeply skeptical of unsolicited text messages. Be deeply skeptical of unsolicited phone calls. Be skeptical. Remember, your bank will never ask you for your full password or PIN. Never click on suspicious links. Never give a stranger remote access to your computer. Treat your digital credentials with the same care you would treat a stack of cash. Third, be strategic about which payment method you use in different situations. Use a credit card for online purchases. Credit cards offer the strongest fraud protections and keep thieves from direct access to your bank funds. Consider using a digital wallet. Apple Pay. Consider using a digital wallet. Google Pay. Tokenization adds an extra layer of security. For small in-person purchases or when dealing with unfamiliar small vendors, using cash can be the simplest and safest option. Cash eliminates the risk of your card information being skimmed. Avoid using public Wi-Fi for any financial transactions, as these networks are often unsecured and can be monitored by criminals. Finally, empower yourself with knowledge. Take the time to read the terms and conditions of the new payment apps and services you use, especially buy now, pay later. Understand fee structures. Understand late payment penalties. Understand how your data will be used. Share this information with your family and friends, particularly those who may be more vulnerable to scams. By making conscious, informed choices and adopting these safe practices, you can confidently navigate the future of payments. You can embrace the convenience of new technology while protecting yourself from its risks. The power to secure your financial future is, quite literally, in your hands.